Good morning and welcome back to Almus Market Mornings. Spain lifted the World Cup over the weekend, and for a few hours at least, most of the world was watching football rather than oil prices. Back to the reality though, this morning we start the week with two unsettling factors. Brent has climbed above $91 a barrel to its highest in a month, while the tech side is once again seeing valuation driven sell off. So both these are keeping the risk sentiment quite tepid. Good morning, JK. What's the theme you would be following for the week ahead?
Good morning, Swaraj. First of all, big congratulations to Spain. They were dominating the play throughout, and it was almost at the end of the first half, although there was no score, it looked as if they were going to be the favorites to win. And it was refreshing to see even President Trump taking time out to watch the match in person, despite all the ongoing tensions. Yes, back to the reality of the markets. So we have fresh attacks or strikes by US, on Iran for attack on Jordan. That left two US service members dead and one missing in action. That deepens fears that conflict will spiral further. So there is a threat about civilian and services also to them, while the global economy is also on alert. The U.S. Central Command, said on Saturday that its seventh day of strikes hit surveillance sites, military logistics infrastructure. So basically, it is now slowly once again escalating even more. One thought that the after the MOU, any escalations will be limited, but it looks like every day it is escalating. So that is quite concerning. Oil already hit 91, which is a whopping 28% from the low that we saw about 2 weeks back. So the market start with three major concerns this week. Foremost, of course, is how worse is the US-Iran standoff going to escalate to, even as oil trades 90 plus. Now, look at oil 90 and earlier. Last time when the oil was going up, there was the buffer of the strategic petroleum reserves world over. All the major countries decided to release out of it and make up for the supply shortage. But this time, a lot of them have been used up, and SPR is now at a decadal lows. So I think if the conflict escalates further and oil starts going towards 100, I think we're going to be really in a much bigger problem. That's what the market, one of the worries. The other worry is whether the fall in retail and wholesale prices in June was a one-off, and there is enough reason to be skeptical also because the Middle East tensions have renewed and oil prices are up once again. More importantly, the strait is far from normal operation. So I think countries which are dependent on oil import, like Japan, and then Europe, which is struggling with high energy prices, natural gas prices hitting multi-month highs as well. I think these and include India, which imports more than 70% of its oil requirements. So faces higher oil prices as well as again supply shocks. And there is already there is a threat that Russian oil import by India would attract again 100% tariff. So there is more challenges again coming to the economies, and that's what the other point the market is watching out for. The third challenge is the tech sector. So the Nasdaq and other AI-related markets have seen a big drop last week. We saw the Nasdaq index losing momentum, overall looking bearish. Japan and Taiwan are in correction territory, having fallen more than 10%. Korea is in actually bearish territory, that is South Korean KOSPI, having fallen more than 20%. The Philadelphia Semiconductor Index is also in bearish territory, down more than 20%. So I think this is giving rise to fears that it can spread to broader market sell-off and a risk aversion. So that's the so we are starting with quite a few concerns. Nothing to be really relaxed about. I think the football fever is over and back to the realities. Markets have to deal with these risks, which are real. And definitely there are economies which are looking quite vulnerable to these economic data over in the last 2 days showed that the US consumption remains stable. Sentiment is also good. Michigan preliminary consumer sentiment improved to 54.4 from 49.5 as gasoline price fall boosted confidence. Although these sentiment remains well below last year's levels and inflation expectations continue to be elevated on a relative basis, although in a month on month it has improved. So I think again, economy is on watch. If things get worse on the war front, I think these are going to be once again on the negative side as well. The dollar has not reacted much so far. Euro and yen, they are holding the ranges. Definitely, the focus is on the yields. Now, yields are not only moving with oil, as we have already shared many times, the AI spending and the demand for capex, which is putting pressure on the money, could be one other factor which is likely pushing the yields higher. That's why we are seeing the 30-year now comfortably trading above 5%, and then 10-year also above 4.55%. There will be a rate hike by the Fed. All these things are supportive of the yields and supportive of the dollar as well. For the rupee, the specter of new all-time lows begins the speculation for the rupee as we are very close to 97 now, meaning another 50 paisa from the level what we are seeing currently at 96.50. We need to watch the central bank actions because while the prices are above the level where they came out with strong measures last month, their reserves are further down, and how much more they can use to rein in the dollar is the point that the market would be watching. But surely this is a point of vulnerability which the speculators might try to exploit, and the central bank would be vigilant about this. So it will be very interesting to see how the bank handles the you know matter if we see 96.5 being broken. All this is even as the flows are only trickling in and no major flows are seen so far. Importer buying has picked up pace after break of 96, including the PSU banks. So all in all, India is again back to the position where it is more on the defensive side. Only thankful grace is that the anti-AI trade, or rather the sell-off in the AI related markets, is actually supporting some of the markets like India and Indonesia, which have been actually on the underperforming side for well over a year. So some fund redeploying of funds into these markets, but not in a significant way to at least influence the currency. So we are on the watch. Both on the oil as well as on the rupee as we start the week. Thank you.
Thank you, JK. And a couple of things themes that we need to look for is geopolitics, oil prices, inflation fear, tech sell-off if it spreads. And these are some major things that's been impacting markets. One interesting notion is that if the geopolitical flare up becomes more dramatic and oil prices spike, this time what's different is that SPRs have already been drawn out significantly, unlike the previous spike. So it may cause a bit more of a tighter supply situation for oil if the prices rise furthermore. And yields are moving not just with oil, but the capex related to AI, and that's maybe also impacting the inflation. Majorly, most of the central banks now are either on a hawkish lookout or on a hiking path. So they are somewhere or the other. So that's another theme that's going on. Rupee, of course, none of the global scenario is currently favoring us, so we remain on the weakening path. That's it from us today. Thanks for listening. We will catch up tomorrow. Fresh round of updates.